Hi, I'm Toby,
And I'm Nick.
and welcome to the Pure Property Podcast with Track Capital, where we talk about all things property and property investment. The aim of this podcast is to give you our industry insight and knowledge to help investors to invest intelligently. And this week, we're going to be going over the latest UK house price index, which has been released by Home Track, which is also part of Zoopla. So some good data to go over. This has been released at the end of October, and we'll have the data for September, along with some current data as well, based on sort of demand and what they're seeing on their platform.
Yeah, so obviously we've got to be conscious that the market conditions are moving very quickly at the moment with various announcements and a lot happening in the marketplace, which me and Toby will go over today. But just to give everyone the heads up, we're going to do obviously a screen share and show this to our YouTube audience as well as our usual podcast audience. So highly recommend you go over to YouTube, just type in Track Capital, then our channel should come up. And once this is published in a few days' time, you should be able to see the report as we're speaking through it. But obviously for our audio listeners, we'll give you the key figures, headlines, and everything you need to know so you can follow along as well.
Yeah, and we'll also put the link to this report in the show notes of the podcast so you can take a look at this for yourself. So let's dive straight in. First thing I will say, it's not as scary as some people may have anticipated it may be, but also it kind of is, in short, saying what we've been saying the whole time. And that's, we can't know exactly what's going to happen. We can just look at the data now, and sort of different scenarios might give different outcomes. But going into the headline figures, so the current UK house price growth is sitting around 8.1%. So still in a positive. So that's year on year growth. Although we know there's been a slowdown due to everything that's been happening, that we are still in a positive in terms of house price growth. The other headline figure, which you'll be able to see here, is there's been a hit to buyer demand. So buyer demand has reduced. And we know this because of what happened with the mini budget. Interest rates, Bank of England obviously putting rates up, mortgage companies pulling products and putting rates up as well. This has sort of dampened demand, which we knew was going to happen when we saw that. Also, interesting figure here, which is probably something that I wasn't too sure of actually, was 48% of buyers in the market are using cash and small mortgages to buy properties. What does that mean by small mortgages? That means low loan to value, sort of under 50%. So they're still active in the market. 48%, that's a big chunk of the market. So there is still good appetite there. Yes, other demand has come out, but there's still appetite there.
Yeah, that's
Then,
really interesting to see. Just to quickly stall on that one, looking at the proportion of buyers using cash, I mean, that's something we see over here in Dubai quite a lot because it is the mortgage market here is far less mature. It's just not the custom to borrow. So we do see a large, 80, 90% of the market using cash. But that's really interesting to see. And, nearly 50% of the UK market purchasing with cash, obviously due to, the reasons that we all know about, changing conditions, interest rates, etc. But do you think that's a pattern we'll see continue, Toby, or do you think that's likely to flip on its head soon?
no, I think that will continue. I mean, cash buyers are always going to be there, and to be fair, they usually come out even more in these sort of scenarios because they can sort of pick up little deals if a property's fallen through because it's a mortgage buyer. They can usually run in and snap it up quickly if the circumstances mean that the seller needs to sell quick. So that will still be there, and I think we do underestimate the sort of the level of cash rich people out there in the market as well. Yes, people like to leverage, and that's because borrowing was so cheap. People were leveraging anyway. It made more sense for them to leverage with mortgages. But what you will see is when the rates go up, those people that thought it was cheaper to leverage, they might say, well, actually, I'll scale that back a bit and I'll put some more cash in and invest that way. So I think that's going to carry on, and especially while sort of the mortgage market stabilizes as well,
Yeah.
they'll be there, and then that will sort of determine obviously the mortgage market, how that sort of comes out, that will determine the rest of the market there, who will be sort of looking to leverage a bit more.
I think the other thing as well is that's probably a lot of overseas guys, right, buying into the UK that maybe they have high interest rates anyway because of the exchange rate and the pound being more favourable in relation to other currency. They've poured a lot of capital. So for us, our key market or our second biggest market is Hong Kong. So we're seeing huge demand from there, and just general overseas investment or foreign direct investment going into the UK, both in London and to the north. So yeah, interesting times.
Yeah, exactly. So in terms of a summary, and these will be explained a little bit more during sort of as we go through this report, but spike in 2 and 5 year fixed mortgage rates has hit the demand, as we mentioned previously, since the mini budget. Sales are still being agreed, but at a slightly slower rate. So, and as I mentioned, that's from cash buyers and those with cheap loans. So there's a pipeline of nearly 293,000 sales in progress. So still strong on that side. There's no signs of an impact on pricing expected in Q4, so quarter four. So for the rest of the year, they're not really anticipating anything to impact prices. But of course, going into next year, we'll come on to that. As they mentioned here, the outlook of for 2023 just depends largely on the mortgage market, really. So what they're saying is mortgages sort of sustained around 6% would lead to a price fall. So they're anticipating sort of double-digit price falls. But what they do go on to say is this is going to erode paper gains on which happened over the pandemic. So, and there won't be many negative equity cases. Now, what do we mean by paper gains? What this just means is on paper, they haven't physically, or not physically, but they haven't actually rose sort of how would you explain that, Nick? Sort of paper gains, they haven't rose sort of properly, if that makes sense. It's just on paper that value's dropped. So over those 2 years, that's where that sort of gain's been made. But because nobody's sort of been, unless you've bought the last year, there won't be any negative equity cases realistically, because if prices drop, well, you never sold the property, you never sort of physically saw that sort of gain or took the money out, etc. So therefore, you're not going to be affected by negative equity. Does that make sense, Nick, if I explain that correctly?
Yeah, I think it's almost, or it might be values which haven't actually been or materialised or been realised is the word I'm looking for. Sorry. So the people holding property, they might have seen these value rises during COVID 2019, 2021. But because they haven't sold, moved on, or transacted, there's no physical, record, or it's not, in the system effectively. So people have seen these value rises or this bubble, and now what they're saying is that these prices are softening or coming down slightly, but not to the extent where it's going to go, into negative equity or below where anyone would like it. That's how I would interpret that.
Yeah, exactly. So I think a sort of a live example would that be if you bought a property for 250,000 just prior to the pandemic, and it rose to 300,000, and the worst case scenario happens, and when you have a price for 50,000 and it drops back down to 250,000, you're not really affected because you've still got, you're not in negative equity. You bought it for 250, it jumped up, but it's always jumped back down, so you're back in the same position. So it's not really financially affected you in that sort of way where you drop into negative equity. If you'd remortgaged at 300,000, and that's then what the value is, and that's what you've leveraged at, and it drops by 50,000, then yes, of course, that would be sort of dropping you into potential negative equity. But yeah, that's what they're saying as a worst case scenario. So a positive out of a negative is that worst case scenario, what they predict means that there won't be the case like we saw in the financial crash or previous recessions where people were falling into negative equity and losing their homes. What they're anticipating that shouldn't be as bad based on that. And then lastly, they just mentioned about robust labour market and scarcity of supply will help support pricing. What they are also noting is that it's the south of England that will feel the greatest impact, and this is due to the prices and sort of the affordability levels, as we've mentioned previously on this podcast multiple times about the affordability levels and where you should be looking when investing to take this into account. A graph that you will be able to see when you look at the report is just showing how demand has come down. The number of sales agreed have dropped, but only slightly. They've dropped by 4%. And the flow of new supply is slightly up, actually. So, but again, only 4%, but still up. So that's good to see more stock coming to the market. And then the stock of homes for sale is actually down still 13%. So although flow of new supply is up, the actual stock levels of homes for sale is down 13%. So we're still low on that.
And that's really interesting, actually, because that does help with the values, because there are people, although not everyone's investing and deploying as capital as perhaps quickly as they might have done a while ago. Ultimately, some people do need to move, especially on the secondary market. It's driven by often a reason. The kids are going to a new school. They need to downsize, need to upsize, whatever it may be. So there is still that base level demand for property. And with that supply level still, low and perhaps shrinking as not many people come to market, that's what sustains the values. And that's why fundamentally the UK is a strong market, because you're never going to get to the stage where there's just a ridiculous oversupply. It just, the fundamentals won't allow that to happen. So that's an interesting point too.
Yeah, and then coming on to the mortgage side of things and the economy. So headline figure that you've got in the report is up 17% is the new mortgage approvals over August. So this is where you had obviously the rates rising and people seeing these rates beginning to sort of go higher and anticipating it to continue to do so and rushing in to get a more favorable mortgage rate. So that's where we've seen a jump by 17% in new mortgage approvals over that month of August. And what the report is saying is political turmoil compounds rising borrowing costs. So because of the uncertainty in the economy and sort of the political landscape, this has meant that mortgage rates have spiked above 6%, just where the financial markets are looking at this and anticipating it to be like a worst case scenario. So they're looking at the health of the economy, and this is then affecting the cost of borrowing.
Just quickly on that one as well, with regards to the I think it's interesting to analyse that. So what they're saying is there was a massive jump in mortgage applications and borrowing prior to the new rates coming in and the interest rates increasing effectively. So for us and for our audience, what you can take away from that is there's loads of people out there that were in the position to buy or invest, and they weren't doing it. They were sitting on their money until they had a reason to, or till effectively they got encouragement from, or that deadline almost. So it goes to show that there is people out there with the capital ready to deploy it. And if you are one of those, you can still get it in the market working for you. You don't need to wait for a reason and for, the government effectively to dictate, or the banks to dictate, when you're going to invest. So it's interesting to see that the buyers could have been active in the market, earning money on their properties, but they were waiting. Oh, suddenly the interest rate's going up. Oh, I better apply now. I better get on with it. So yeah, don't sit around.
Yeah, exactly. Yeah, don't wait around too long. And then the uncertainty squeezes out new buyers. So with the jump in interest rates and mortgage rates, this is what they're saying has been the largest interest rate shock for new buyers since the late 1980s. So the immediate impact is on households that haven't got mortgages arranged yet at the cheaper rates. So, and most of them who are now sitting on the sidelines. So this explains why the buyer demand has sort of fallen by a third since the mini budget. So this is similar to what you typically see as a seasonal slowdown in late November ahead of Christmas. So we always have seasonal sort of slowdowns and sort of ups and downs throughout the year. And what they're saying is this happened earlier due to this. We usually see this late November. But obviously, as we mentioned previously, you've still got cash buyers and people with good sort of capital sitting there still purchasing in the market, and the sort of dwindling pool of buyers with cheap mortgages. So pent up demand to move is still there. So you've got the households, obviously, which they rushed to secure the low cost mortgages over summer as rates started to rise. So yeah, as we saw, they jumped by 17%. And when you look at the graph for the new buyer demand, which you can see on the report, you'll see that how sort of you can see the slowdown and the drop in demand. What I will say is, although it's lower than 2021 and 2020, you do still see a slight decline at this time of year anyway, but that's just been sort of exaggerated and sort of further pushed because of the mini budget and what we saw with the interest rates from the Bank of England and then the mortgage market as well. There's still a good pipeline of sales, so that's good to see. So you've got circa sort of 293,000 sales in the pipeline. So they're anticipating that we're still on track for nearly 1.3 million sales in 2022. So still sort of good. And again, as mentioned in sort of the previous sort of short outlines of the headlines, that it's too early to tell what impacts we're going to see on pricing in Q4. So we don't know. What they do go on to say is we don't expect to see anything materialize in terms of pricing impact throughout the rest of the year. We will get an idea in the first quarter of 2023 because it does take several months of pricing to adjust in the face of weaker demand as well. So you have to bear that in mind. There has been a short-lived surge in the number of homes coming to market, although the number of homes for sale still remain below average. So, and around 7% of homes for sale have seen the asking price reduced only by less than 5%, which is an increase on recent months, but it's still below 2018 levels, which again was a healthy market. So not drastic, not scary, and a very, very small portion of the market. So do bear that in mind. And the latest index shows average house prices increasing by 8.1% over the last year due to the strength of demand and the sales agree over the last 6 months, which continue to push prices higher in the face of ongoing shortage of houses for sale. And as we know, it is starting to slow house price growth across all areas. And we will see that slow growth, sort of the slowdown, in growth continue into Q1 of 2023. Again, nothing scary. We've been in a very, very explosive market and we're just seeing it come down to normal levels. So do bear that in mind.
Just to jump in to give some practical advice on this point, going back a couple of points, Toby showed the graph of the buyer demand slightly decreasing. This goes back to what we mentioned last podcast. Yes, if we look at the property developer sales, so if you're buying a new property or buying something off plan, don't forget now is still November, December is a perfect time to push for those negotiations. We really hammered this home last podcast, but what you've just seen is evidence of the market and the demand in general slightly decreasing. Now, a property developer will look at that and go, okay, right, we ideally want to finish off this scheme by the end of the year, or we want to get this target number of sales at the end of the year. We know because we speak to them day in, day out, we know how they think, what their mindset is. They'd rather have, stock cleared off. So it's a great time to get a couple of deals, negotiate, renegotiate if you need to. But I thought it was worth touching on that because, yes, we mentioned it last week, but here is the hard evidence to show the market patterns and what you can use. You could even take this and send them the report and say, look, we're seeing this happen in the market, et cetera, et cetera. What can you do? I'm conscious of this. Let's negotiate a deal to make sure we can commit and move forward. So, yeah, don't forget that, guys.
Yeah, that's a great point. And do always bear that in mind. As we always say, as long as you can back up your negotiation with evidence and you're not just doing it for the sake of it, it will be received in a lot more favorable light than if you just sort of bullishly go in and say, I want money off just for the sake of it. Yeah, exactly. The developers and sellers don't like that. When you back it up with evidence, they will take it more. Doesn't mean that they're necessarily going to accept it or negotiate in a way that you'd like them to, but they will receive it a lot better. And lastly,
just quickly,
on this,
guys, sorry, mate. Before we move on, imagine if you're you're competing for a unit, for example, with a developer, or you're looking to buy something, and someone asks for a discount, and then the next person asks for a discount, and they give a solid investment case, solid examples. This is happening. This is the interest rates. This is the buyer demand. So as a result of this, I can move today if you can give me this price. Who are they going to listen to? Who are they going to be more interested in? Who do they think is a more motivated buyer? The person that's done their research and coming armed with knowledge, or the guy that's just asking for a discount on the first call? So, yeah, really, really don't forget that.
Yeah, very good point there again, Nick. So just lastly on the sort of the mortgage rate side. So what they're saying, and this is something I've been saying for a while now, is realistically next year is going to be determined, and the house sort of price and property landscape is going to be determined by the mortgage rate. So we don't know where that's going to go. Now, a lot of people in the industry, whether that's the mortgage industry or the property market industry, are anticipating that we are going to see them fall back down to sort of a more reasonable level, say between 4 and 5%. So that's what's going to determine what the market does. What they're saying is if it does stay at 6% or above, then we will see have a slight negative effect on the property market in terms of prices. But if they do drop down, like a lot are anticipating, to sort of 5%, maybe 4 or 5%, then that's sort of a level which will be fine. And then the property market should sort of continue on in a better way, a more healthier way anyway, because what they have seen is 5% is the sort of anything above that's the tipping point at this stage in the property market, which will affect demand and therefore growth, etc., as a whole. So that's what we're going to be waiting on. That's what we're keeping a close eye on. It doesn't mean if rates don't start coming down now or in the next few weeks or even towards the end of the year, you should start panicking. It's going to be sort of Q1 next year. We'll get a better idea of how that is going to look. I mean, the spike in mortgage rates is making housing unaffordable for quite a few. But again, Home Track have done really good on on this report by sort of breaking down and giving some previous examples, which again doesn't make it seem as scary as you might think. Because as soon as you hear about, the property market crashing, recessions, etc., you think of 2008 crash, you think of the late 1980s sort of recession and house price crashes, etc., and you do get worried. But when they break it down by the data and sort of comparisons, it's not as scary. So what they've got is they've got several models which assess the impact of changes to the fundamentals that drive house prices, and one of them tracks the relative over or undervaluation of housing against a sustainable house price benchmark. So it looks at the sustainable house prices and it looks whether you're running at over valuations or under valuations. So that the model that they've got shows prolonged periods of house price overvaluation in the late 1980s and the run up to 2007, which obviously we saw the house price crashes. So what that means by overvaluation is people were buying at overinflated prices, which caused the massive crash. So if you're buying in a very busy market, but you're still buying at market value or slightly under market value, just means there's less room for a drastic effect on the market. And what they're saying is that this hasn't been the case in the last decade because prices have been rising in line with market fundamentals. But mortgage rates jumping to 6% or above, this is what will create a sizable overvaluation compared to a sustainable price benchmark that they have and what they monitor this on. So that's what it's saying. It's saying, like we just said previously, it's the mortgage rate which we're going to anticipate to see, which will affect the market. So yeah, the scale over historic overvaluations in prices does not translate into subsequent real world price reductions as mortgage rates adjust and borrowers can adjust how they fund purchases. So, and it usually takes about 1 to 3 years before we see sort of the real impact in this. So relaxations in lending criteria for new borrowers and or tax changes can lead to a prolonged build-up of an overvaluation in prices. So this compounds the size of subsequent decline in prices. So the more you see that, the more you see a reduction in prices, which was the case in the late 1980s and the run up to 2007 because lending criteria, well, we know anybody could borrow. It was just absolutely crazy. 100% mortgages you were getting. It was just crazy. But in the recent years, this hasn't been evidenced. This hasn't been there because they've been much tighter in terms of their lending criteria. That's why affordability levels were previously stress tested around the 6 to 7% mortgage rates. That's why, yes, rates have gone up and it's stretching for a lot of people. But with the stress test, most people in mortgages currently at the moment in their rates should be okay. Doesn't mean it's not going to be hard for them, but those stress tests have helped that scenario. But what this means is going forward, the stress test will probably go up. So there was stress tests in between 6 to 7% rates before. That'll probably go up to around 8% now, which is squeezing the buying power for new purchases. So in simplistic terms, the stress tests and the strict criteria helps protect the property market to a sense. But going forward, because the stress tests are there, it's going to be harder for people to sort of purchase and move up, because again, what you don't want to see is lending for everyone, and this is what creates just a crazy market, a bubble that will burst like we saw in the late 1980s and the run up 2007. Have I explained that all right, Nick, or does that sound a bit confusing?
No, it all makes sense to me. I think it's a relatively simple concept to comprehend, but I would encourage everyone to go and look at the report directly and actually read it, because it's really interesting, and you'll be able to digest it a lot more easily. But in essence, the prices increased aggressively due to relaxed lending leading up to 2007, and then after that we've been a bit more tighter, and we haven't seen as much overvaluation, so the drop will be less of an impact as well, as Toby touching on sort of the buying power there as well. And I think we'll look at how this will play out in 2023 in a second.
Exactly. So moving on to sort of what will the hit to buying power play out like in 2023. So to summarize, like the theme has been, if throughout this whole sort of episode is if the mortgage rates move back towards the 4% rate sort of throughout next year, probably towards the end of next year, then look, the property market should be fine, and it should move along. This will be even further accelerated if you do have a minimal price drop. Let's say prices fall by sort of an average of 5%, which we're not anticipating to happen. I'll give my sort of thoughts afterwards, but that would sort of accelerate sort of the correction even sort of further and more quickly. So a move back in mortgage rates is going to be very good, and will likely see the property market be good and positive sort of next year and moving forward. So at present, they believe that that's going to be the most likely outcome, which will be accompanied by a decline in slight sales volumes over the year, down to about 1 million. But again, still in a good position. So what we'll go on to is what the annual house price growth is looking like in the major cities and locations, and then I'll give a summary of my thoughts of what I think the market's going to do, and Nick as well. So yeah, I mean, just on this, I won't go into this in too much detail because it's becoming obviously fairly repetitive, but the house that sort of half sales are cash, or small side mortgages, and there is a graph which demonstrates that. So you've got about 30% of purchases at the moment are cash, 80% are 18 are loan to values under.
Mate.
Yeah, sorry about that. Loan to values under 15%, so very low loan to values, and then between about 22% are 50 to 75% loan to values. So yeah, again, it's just showing that there's a big portion of the market that are still there. So their outlook, which you can read in the report, is like we've said, just depending on the mortgage market on how things will go, but they don't see it being too scary. But again, we'll just see what the mortgage market does in terms of house price growth. Nick, why don't you run us through the top cities for house price growth and what they're looking at the moment on an annual change?
Yeah, certainly will do. So just to refresh everyone, this report is the most comprehensive market report available in the UK. So as Toby said, it's from Home Track, who are owned by Zoopla Group. So they look at the rolling capital growth rate over the past 12 months. So we'll give you the averages of the previous year performance, but just remember the past couple of months, that average might have, or that figure might have dropped slightly. So this is looking at the entire 12-month period. So still some very, very impressive figures here, which you wouldn't believe if you read or took notice of the news. But Nottingham, past 12 months, nearly 11%, so 10.9% in terms of the annual percentage change in house prices. Closely followed by Manchester, who's always up there, 9.3%. Birmingham, 9.2%. Birmingham seems to be performing a bit better lately, I must say. Leeds, again, another solid performer, 9.1. Bournemouth, which is very rare to see, being at the other end of the country, 9%. Leicester, 8.7. And then between 8.6 and 8.2, you've got cities like Bristol, Sheffield, Liverpool, Portsmouth, Belfast, Cardiff. And just to quickly touch on those three, we're talking over 8% value rises in your property. So at the start of the year, it's worth 100 grand. End of the year, it's worth over 8 grand. It's 108 grand, sorry. Look at the vast areas that those cities cover: Cardiff, Belfast, Portsmouth, all the way up to Sheffield and Liverpool. So it's not a concentrated area of the UK that is seeing, the most capital growth, although we would certainly have our top picks. And then if we go down to Southampton at 7%, Newcastle 6.3%, and then into some very premium areas, Cambridge, Oxford at 5.3 and 5.4. And then lastly, we're back up to Scotland, Glasgow, Edinburgh, 4.6 and 4.2 respectively. So yeah, really, really positive. Again, that's over the past 12-month period. That might have, slowly adjusted over the past couple of months or so, but a good, variety of cities featuring in the above the 8% mark there. And just to recap on the average then, 8.1 across the country. One I will mention is Aberdeen. That is one of the top 20 largest cities in the UK, but that's minus 0.9%. So yeah, as long as you're picking carefully, you'll be absolutely fine.
Yeah, it's interesting to see the locations by regions as well, because you've got, Wales 10.5%. What else have you got there? You've got Northwest 9.3. So these regions, East Midlands 9.9, doing very, very well. Southwest as well. When you think of the prices around there, 10% increase. So look, this is an annual rate, so month by month that does change. So just do bear that in mind, because we have seen it slow down. But yeah, still positive as a whole in terms of, if you look over this year, with everything that's happened, if you go forward in 10 years and you look back at the year 2022 and you see what prices did, you would not be thinking it was a bad year for the economy or for the property market in general. You'd see those house prices and you'd be like, well, what was everyone complaining about? But of course, look, we know the bigger picture. But yeah, it's interesting to see that. Right. Yeah, so just to end there then, my thoughts and my summary on where we're at the moment and potentially where we'll be looking at next year. So pretty much in line with the theme of this, it is going to be determined by obviously the economy, how the political landscape plays out, which will then in turn affect the mortgage market and what the rates are going to do. A lot of people I'm speaking to are, when I say people, I'm not talking about just Joe Blogs down the pub. I'm talking about people within the industry, mortgage market industry and the property industry, are anticipating that the mortgage rates should be coming down to that 4 to 5% level. We've just seen the financial markets be overcautious by the uncertainty of everything we've seen in the market, with Rishi Sunak now hopefully bringing some stability to the country and the economy. They are then anticipating that and we are already seeing the easing slightly of a sort of a doom and gloom outlook by a lot of these the financial markets. So we're anticipating that to be the reason to bring that down. If that then does come down to the sort of 4 to 5% level, I think next year we find ourselves in a nice steady market, as long as there's nothing else which is going to disrupt us in any sort of way, which again we can't anticipate, or disrupt that market. I think then we'll have a nice steady property market. I don't think we'll have declining prices over the sort of annual period. I think we'll see fluctuations during the months, but I don't think it's going to be bad. I don't think it's going to be drastic. And I just think it's going to be turn into a sort of a nice, steady market, which we like because it's easier to navigate in a market like that. But that's just my sort of thoughts. I mean, Nick, based on what you've been reading and what you've seen, what would you sort of anticipate?
Yeah, I mean, I'd largely agree. I think if you look at the bigger picture, it's the same old story, right? It might be soft, or it might be a little bit slower for a year or two, and then we'll go back into the phase, back into the the cycle again, as we saw with COVID, Brexit, recession, just the same thing happens over and over. But it is tempting, and this was a very long form podcast, very analytical, very data driven. It is tempting to analyze every report, every bit of data, and go into really sort of micro detail about the performance of the property market. Is this street better? Is this property is 20 square feet better? Do I have to go for that? You've got to look at the big picture. You've got to stick to fundamental, investment principles. And if you do that in the long term, you'll be absolutely fine, which is something that we almost repeat on a weekly basis. But if you are analytical, you're a numbers person, have a look at this report and go over the details that Toby's run through today. Otherwise, the bigger picture is, yes, it might be soft. You might get a few media headlines, going about over the next 12, 18 months or whatever. But no doubt about it, we'll see that positive growth come again soon.
Exactly. And just to conclude, look, the market isn't as scary as the media would make you believe. When we break down the data and we look at things, obviously we can see it's not that bad. Obviously, there is still slight uncertainty, which you have to take into account. But also, what this report touched on as well, and this is why we say about location and being sort of fluid in where you can invest is very important, because what they're highlighting is that it's location which is going to determine sort of where's going to do well and where not. In these other locations where affordability levels are still good and people aren't being stretched, like the north of the country, you won't see as drastic as it is here in the south being affected. So again, just bear in mind, that's why those places probably will still continue to grow, will still be a lot stronger. And if you go to that market to go and buy, it'd be very different in comparison to buying down the south, where people are stretched and maybe a bit more desperate to sell, etc., or move along. But yeah, that's a conversation for another day. But again, that's why it's just very important to look at where and how you're investing. I hope this has been insightful. As I said, do check out the report. Make your own conclusions. Do more thorough research. We always recommend that. And yeah, if you do have any sort of further thoughts or want to discuss anything we've discussed on this, or even disagree with us or want to discuss it, please get in touch. We always love having those conversations. Reach out, info@trackcapital.co.uk. Just ask for myself or Nick, and one of us will be in touch, and we can discuss further. Nick, anything else you want to finish on?
No, that's it. All good for today, guys. Just the only other thing I'd mention is we are on the front line. So yes, we look at the reports and look at the market data, but our team and sometimes me and Toby directly are speaking to investors every single day, and obviously property developers as well. So we do see what's happening out there. We did mention this on our last podcast, but October has been, or to finish off the full October, it was our busiest month on record ever. So that's in terms of total value of fees generated, and also individual property sales on the new build and off-plan market from across the UK. So there's people out there, they're active. A lot of people are putting money into off-plan, where they put down a low deposit, they wait 2 years for the market to stabilise, the interest rates to balance out and even out, and then when their property completes, obviously they can look at a mortgage at that stage if they choose to. So yeah, really, really exciting stuff happening. We actually are very positive about a strong outcome to the end of 2022, and obviously we're doing a lot of activity in the Dubai market as well, which is absolutely booming. So exciting stuff. It's not all negative out there, guys, but yeah, hopefully we can catch up with you soon and speak further.
Excellent. Thanks for joining us. We'll see you next time. Bye-bye.
Thanks, guys. Bye-bye.